You can go down the pipeline with somebody, but if you don't actually know how to really get them excited about something, you go back to treading water, right? So you hope that that 1 to 2 deals gets you a 20 to 50x that then makes the opportunity meaningful. If you don't know how to tell a compelling story, how are you going to get customers and how are you going to recruit employees? Can you paint that big picture that lets me know that this is going to be a outsized outcome? And then are you able to create a sort of effect that makes me want to invest in you today?
Welcome to the Raise and Exit podcast, where we are going and providing entrepreneurs and founders with the insights that they need months, if not years in advance of having a successful raise and exit and getting the wisdom of the crowds from the actual funders and investors that are out there. Today, I'm excited to have on our show Sean Nasiri. He is going to be providing a very different perspective from some of our other folks that we've had on the show, because he actually manages funds on behalf of a family office. So we're going to get to learn a little bit about the different mentalities, the modes, when the funds are not coming on behalf of a consortium, but on behalf of the family office itself. So Sean, pleasure to have you here. Please tell us a little bit about yourself, your investment philosophy, what you're doing at your fund, and then we'll dive right in right after.
Awesome. Thank you for having me, Edgar. So name's Sean Nasiri, was born and raised in Silicon Valley. So I've sort of been around the whole tech venture ecosystem from a very early age. Was building computers in my early teens to pirating illegal software and burning music CDs growing up. I had the unique opportunity then when I got to college. Being a young kid from Silicon Valley, my goal was always to get out of Silicon Valley. Unfortunately, I was in college during what I call the silly app craze, where every young person now wanted to be an entrepreneur because you didn't need to run a business. You just needed downloads and daily active users for some silly iPhone app. So then I ended up having to lean in, and I kind of established myself as the go-to de facto person on campus for all things startup related. This is actually where I met my partner. We had a summer class together during our undergrad at USC, our alma mater. Fast forward about a decade actually on the dot later. We joined forces in 2021 to start the venture practice for his family. Family's based out in Abu Dhabi, prominent family out there with his father works in government. And we've since gone on to do 16 direct investments. And we've also taken LP positions in 5 funds. At the end of the day, we operate with a high level ethos of good founders make good companies and good businesses make great businesses. We're a generalist fund, and we could talk a little bit more about like the nuances and benefits and flexibility that comes with being a single family office versus having fiduciary LP responsibility. But we started off investing in enterprise SaaS because it was safe and easy to digest. We then moved on into cybersecurity, infrastructure, obviously AI. We even did one media deal. And we did 2 deals in the more advanced tech hardware space, which was a no-no at the time, but it's actually our 2 best performing companies. Me personally, as a tech enthusiast, I've spent the last year and a half diving deep into the whole AI infrastructure stack, starting from the data centers and servers and chipsets all the way through, the application layer. Spare time, also enjoy, learning about photonics, nanotechnologies is kind of my next deep dive. But I think there's a really exciting future happening in terms of automation and robotics that I hope to have a little part of and be able to contribute to its success.
That's really awesome. I love the fact that you're kind of just seeing not just like what is there as an investment grade activity now, but can become an investment grade activity for a longer time frame. And that actually brings me to an observation I'd love your perspective on. A lot of the historic VC cadence has been like 12 to 24 month timeframes in terms of cutting checks, Series A, Series B, Series C, etc. In private equity, there's always a framework of like, hey, 3 to 5 years, we got to really get out of this. There's some funds that have a longer time frame. But what is it like inside the family office? Like, there's a range, of course, of family offices. Some are just going to give their money as an LP, but others are active, like you are. So is it different having patient money or having some of those third-party fiduciary obligations removed, which are generally administrative or bureaucratic by necessity. So tell me a bit more about that. How does that change your perspective of what you're willing to consider that a VC might not or a growth PE might not?
Great question. We'll probably need to break it down a bit again, because there's a lot of good stuff to cover. But I would say, uh, f- for one, there's different structures of family offices, right? You have certain family offices where the principal, the head of the family, is involved in all the different parts and is around day to day. They have a full, robust team. They invest across different asset classes. Then you have a single family LP structure where the family has essentially given the capital to a single person and it's up to them to manage the funds. It's a bit more of a passive strategy.
Yeah.
And then there's the hybrid strategy, which is what we employed, which I've kind of branded as self-directed venture services. So this is where you have people from the family that want to be involved. They're interested in startups. They want to meet founders. They want to have a seat at the table. They know there's areas they can add value, but they're too busy to source and vet deals. They can't attend the conferences. They're not plugged into the deal flow networks, and they need somebody else who can, source, vet, package, button it up, and make it in an easy to digest format.
Yeah.
So then to continue down with that sort of train of thought, the primary difference between a family office and a traditional is both groups still have fiduciary responsibility to their investors. But when you go out and raise a fund in sort of your private price placement memorandum and in your offering documents, you essentially do have to really map everything out. And as a result, your hands can be tied.
Yeah.
Certain funds have limits in terms of capital they have to keep on cash. Certain funds have limits in terms of where they're allowed to invest in terms of industries or market cap size. So a venture fund does tend to become a lot more limited. And then I would say the biggest one is also just on returns expectations, right? So a 3x return, right? If you triple somebody's money, that's great for one
Yeah.
person. But a 3x is not really going to move the needle when you have to chop the pie up 25 different ways. So typical venture investment to reach maturity is 7 to 10 years. And for VCs, they need that asymmetric sort of return profile to pay people back meaningfully, right? So you also have to return on the full fund. So with us, we can return on a per deal basis. So if you can get a 2 to 3x on each deal, compounding, then you're sitting pretty, right? If you give me $1 million, I turn it into three, I turn it into five. We can do this all day, right? But if you have a fund, let's just keep the number simple, a $100 million fund that puts you in a decent category. Now we're seeing $6 to 8 to $10 billion funds, and we can talk about how that changes the dynamic of structure and just the identity of venture capital as a whole. But if you have a $100 million fund, you need to return a 3x on the fund.
Yeah.
So you have to return $300 million in order for there to be a DPI multiple, which is what most funds are targeting. If you're doing public markets, you're doing private credit, 10 to 15% annual is great. But venture, we measure in X's,
Yeah.
right? So I need to get a 20X. Let's just keep it simple as well, right? You do 10 investments. You assume 2 or 3 will fail, but in most cases, probably 6 to 7.
It is close.
Let's
It is
say
closer
you're
to 6 to 7. I think this is the
right.
piece that's there, right? Like there's the spray and pray model where you try and invest into like 30 different opportunities with small amounts and hope that 10% of them hit big, right? But if you're doing only 10 investments, I think it is that. Like you got to expect 6 to 7 to fail and the other 2 to 3 to carry.
And I don't want to say all
Yeah.
fail, but they'll be break evens. They'll churn water forever and just never exit. But yeah, you hope that 1 to 2 deals gets you a 20 to 50x that then makes the opportunity meaningful.
Yeah, no, I think that's absolutely the case. So let's just kind of build on that because what you're talking about is a big part of what we have in this podcast, which is helping understand the mentality of the other side. And as somebody, as you said, like you've been in this space from multiple angles, what have you seen is the shift that might need to occur for a founder or an entrepreneur in their mental model in approaching a source of capital? Like they're of course trying to go and have their idea hit big, they need the cash, they have the forecast, but what's something they might be forgetting about or not be aware of that they need to consider on the part of somebody who's actually going to cut the check?
Yeah, that's a good question. So we're going to talk about this from the founder raising money from the VC, not the VC raising money from
Correct. Yeah.
potential LPs.
Yeah. What should the founder be thinking of that they may not know to think about?
Yeah, so a common issue I see a lot of founders make is they don't know how to make things enticing, right? VCs see a lot of good deals. They meet a lot of smart people. And you can go down the pipeline with somebody, but if you don't actually know how to really get them excited about something, then you could just, you go back to treading water, right? So you could be a really savvy, smart investor, but founder, or you could be a super technical, not super personable founder.
Mm.
But if you don't know how to tell a compelling story, at the end of the day, I think the step one for me is, can the founder tell a story? So first thing I always have a founder do, I'm like, so tell me about yourself. Tell me about what you guys are building, how you got here, where you're at today, and big picture, where you want to take things. So some founders have learned how to talk about themselves. Oh, here's my journey. I went to this school, that school. I studied this. I achieved this. And here's where we felt the pain point to start our business. Now, when it gets to that part, it's like, all right, here's where we started our business. Here's what we do. 70% of founders fall short.
Yeah.
And that's generally a red flag because, listen, there's also a lot to be said about somebody who's a tremendous fundraiser and a really good storyteller, and those don't always end up panning out either. But if you can't tell a cohesive, methodical, compelling story, how are you going to get customers and how are you going to recruit employees? So it's an absolutely crucial step.
I want
Part three,
to add on that second point because you said something that I have not heard that much talking about, which is, that we have that founder centrality, right? It's like, oh my gosh, like this person or this small team, like, oh, they got this exceptional skill set. But that ability to go and recruit, right? It's a different type of storytelling because you need to go and convince somebody to come and join your organization versus another. And sometimes like an equity incentive is just not enough, right? Like you really need to go and have people go and say, hey, I want you to take a portion of your life and have it jump on this train that we're going and riding full steam ahead, or whatever analogy which you want to go and use, right? So I really love that nuance that you're going and putting in because I'm not hearing a lot of that being asked, right? Like what's your strength in being able to recruit people, et cetera, et cetera. So I love you saying that, Sean. That's great.
yeah, I think there's a lot to be said about that, right? So one, you can bring in your inner circle, right? You could go out and bring people who are in the same field as you or who have some expertise. And I think that'll get you from 0 to 1.
Yeah.
But to get from 1 to 10, you need to be able to go out and really recruit. And after a certain point, depending on what industry you're in, I'm going to want to see that you're able to convince somebody from your biggest competitor or the established player, and you're able to convince them to come join you.
Mm-hmm.
And really the sweat equity piece is actually technically a part of that same thing, right? Because if you're expecting most of your compensation to come in the form of equity and you're taking a haircut on salary, then you need to have the utmost confidence that this company equity is going to be worth something.
Yeah.
But let me get to the third piece, and this is where 99.5% of company founders fail, is articulating where you're trying to take the business. What is the future grand vision? This is your chance to create excitement and potentially like a FOMO effect as part of your story.
Yeah.
It's what is the big picture that's going to make me want to invest in you versus the 25 other companies I've met with this month and the 250 other emails I'm scrolling through right now. Can you paint that big picture that lets me know that this is going to be a outsized outcome? And then are you able to create a sort of effect that makes me want to invest in you today.
Yeah, I love what you're
Granted,
saying there.
closing on the first dime doesn't work as much anymore, but can you create some sort of X factor? Can you create some type of FOMO effect? Can you create some type of artificial demand? Now, a lot of people will create an artificial timeline, like, oh, this is moving so quick. Today's Thursday. We're oversubscribed. I would love to get you in. I'm going to need your commitment by Monday, and I'm going to need the document signed by Friday.
Yeah.
That happened a lot during the COVID sort of no nonsense bull market.
Mm-hmm.
Every founder was putting a gun to investors' heads, and for the most part, they were able to get their money. But now that's you're not going to get away with that.
How robust does that visioning have to be? Because like I sometimes roll my eyes when people go and try and put together these pitch decks and like, oh, we're selling into a $60 billion TAM, and you're like listen, your turnover is like not even $1 million a year right now. I always like the idea of it like being a stage. Like, can you articulate your pathway at various stages of revenue? Like, where are the lowest hanging fruit, right? Who is the most vulnerable customer? And I think that goes to your aspect of storytelling that is there. And I'm not a fan of giant TAM storytelling. I'm a fan of how I'm able to penetrate into that giant TAM of storytelling. So tell me a bit about like your perspective on that. What are you looking for? What do you ask of companies that you're looking to invest into as to how well they actually understand that vision?
Yeah, that's a good question. So, and I'm with you, right? If someone's pulling up these crazy financial projections and they're being a little too salesy, I think your BS meter can pick that
Yeah,
up.
yeah,
And let's be honest, that's especially before Series B, it's all about the people, right? So, as an investor, you kind of need that deal velocity, right? You needed to see hundreds of founders year over year, either socially, casually, or direct pitching environments to really be able to reflect on who has it and who doesn't have it. And there's different ways of having it. There's super technical guys that, you talk about like the Silicon Valley autistic Asperger founders who can barely make eye contact. But if you get them rolling on their product, on their technology, on the ecosystem, on the trends, it's like then you really get to see their time to shine.
yeah.
So one basic question that few people answer correctly, and it can kind of tell you what type of vision this founder has is, I'm like, all right, so let's say you're raising $5 million today. Let's wave our wand and say the 5 million was in today. We're 24 months into the future now. What's your company look like? What are you doing?
Mm-hmm.
And it throws a lot of people off, but it's like, if you get the right founder who's truly thought about it, who's dreaming about it, who's spending all day thinking about his company, his vision, and he has a big picture in mind, he'll be able to tell you, he's like, okay, we got 3 offices, one here, one here, one here for these reasons. Our team is now this big. We've hired this many engineers. We brought in sales talent from these two companies. We brought in a new C-level suite person with gray hairs to run it. We have between this many customers, and we're doing at least this much revenue. We've probably rolled out this, and this feature. And you're like, okay,
Oh,
this guy's really eating and breathing this stuff.
I think what I want to add to what you're saying is it's not that it's going to turn out exactly like that. It's that it's a
No,
legitimate, thought through vision of how this can turn out, meaning that you've thought through the alternatives that is there. And I think it's that aspect of like, and I don't want to call this data driven storytelling. I actually would view this more of like, thought through storytelling. You've actually kind of
yep,
understood what are the constraints and the potential for your company that's there. So I love that nuance of what you're bringing. I think it's a more kind of like time-based modeling that is there. I think it's that less like short-termism of like, hey, how can we maximize this investment right now that might be there in some funds. So that's really interesting for me as a perspective. I want to shift a little bit to like the build of that philosophy being embedded in your fund. Why would a founder want to seek out a family office such as yours to be cutting the check? Because we have to remember, right? VC has changed a lot, especially the past decade. Like it's
yeah,
become much more diverse. There's people who've exited and have started their own first check funds where they're just making the decision themselves. That practically didn't exist 25 years ago. So curious to know from you, like in that diverse set of where you could go and get money, Why would a family office be something you want to consider, and when should you not consider a family office as well?
Great question. There's a couple different ways to look at this, right? So I've actually found, especially when it comes to advanced, deeper technologies that have raised a lot of money, it's actually a bit of a red flag if they're only raising from angels and family offices. You should be raising from traditional VCs. You should be trying to raise, you don't want to raise necessarily from tier one blue chips right out the
Yeah.
gates, but you do want to raise from VCs who have a history of leading deals because it's a stronger signal. And those VCs and a lead in general is supposed to be the one that does all the diligence, the deep level of diligence to make sure that the numbers are right, the customers are happy, the pipeline's real, all the I's are dotted, all the T's are crossed. As a small family office, all I can do is once I like you, I have to make sure you like me. And my goal is I add as much value as I can to any company I like, no matter what, whether we invest or not. But that ends up actually becoming like our serendipitous, all right, we have something here moment. So let's say we've met twice now. Or let's say even after our first meeting, I'm
Yeah.
like, okay, cool. You do this, you're specialized in this vertical. I have three people in my network. Let's say one is a vertical specific investor in your vertical. Another one is at a firm that specializes in covering this and has the big winner in it. And then the third person is somebody I know who's a senior level executive that works in the space as well. This is assuming I liked you and I definitely want to take a second meeting and I'm interested.
Yeah.
So my next step is, all right, cool. I'm going to talk to all of them
Yeah. Yeah.
and they're going to give me their feedback and they're going to tell me what their thoughts are and what the likelihood is. Based on those feedbacks, I'll decide to take the second meeting. And after that, I mean, the other portion of that is, do I know anybody that could serve as a customer for them? Is there anybody in my network that could come in at a senior level and work with them? And we do these for almost every company we like. But if something ends up happening, they end up working with a customer. They end up looking to hire one of the executives or one of the more vertical specific or blue chip well-known investors decides to make an investment. Now we know we have something differentiated if we're looking between investing in company A, B, or C in that given time period.
That's awesome. I think what you're pointing to is it's almost like a process of due diligence to see how have you as a founder conducted due diligence on yourself by getting that signal understanding from the various degrees of scrutiny that can come there from different types of funds. And I think that is such a valuable insight to go and put in because there is kind of people going and saying like, oh, like don't spray and pray, etc. But I think you can be discreet in going and figuring out how much appetite there is there for you and crafting that narrative for you to go and sell. So Sean, this has been fantastic. I could go on for an hour with you, but I do want to kind of ask on your, for you, just quickly go and say like, how can people find you? Like, where can they find you? What's the best way to reach out to you in case they're interested in having you be one of the firms that they come to get a check?
Yeah, thank you. Been a pleasure chatting with you as well. I wish we had more time. I feel like maybe my answers were a little too long-winded. We didn't get to
No,
cover
you covered so
too much,
There's a
but
round two coming,
uh,
Sean.
okay, perfect. I mean, listen, I think there's some good nuggets in there for your audience and whoever's going to be listening. But easiest way to find me is I'm getting more active on LinkedIn. I'm starting to post as much as I can and repost interesting stuff. I tried my luck at Twitter or X. I don't know how to go viral or get followers there, but you can follow me at SSN 95070, LinkedIn, Sean Nasiri, or email me, Sean, SEAN at JAS.ventures. While LinkedIn is a great channel for us to connect, it's a very noisy channel for DMs and messages. And I admittingly do not get to those as quickly as I do my emails, but always happy to chat. As I mentioned, I mean, we're a family office, so we can look at anything and everything, but I've been very more narrowly focused on more advanced, deeper technologies and the whole AI infrastructure stack, not so much the application layer, unless you have some very hyper verticalized solution with a proprietary data set built in. I'll definitely take a look at that. But if you're doing anything that operates in the background, if you're doing anything on hardware advanced technologies ranging from photonics to inference chips, if you're helping make AI work better, more efficient, more cost effective, I think if you're doing anything within energy, yeah, definitely please reach out.
Amazing. Sean, thank you so much. Till next
Thank
time.
you. Have a good rest of your day.
My interview with Sean Nasiri was really insightful because of the fact that you have a very different type of investment thesis and philosophy when you're trying to go and raise capitals from family offices. And why does that matter? Well, because family offices have a completely different structure and timeline from the typical venture capital or private equity universe. Sometimes they're very similar in their mentality, but if you understand how the family office invests, they may go and have a very different timing. They may want to go and take the whole round, and then you go and potentially have patient money. You also may have impatient money. But going back to the conversations that we went to have with Sean is you want to understand that you get that fit and alignment with the family office money as an alternative to traditional venture capital that is there. So the ability to go and raise money for companies today has become so diverse. And what I invite you to consider is how will you position yourself differently from a family office based on the conversation that I had with Sean versus a more traditional venture capital domain that is covered so much. So I invite you to look at, revisit this conversation with Sean again, look at it, how does it matter for you from a raising of capital point of view, and then take that insight to the next level as to how that can be an advantage to going and getting a next round and the next round, because the family offices, they have their own networks as well, who they can bring that you'd never have access to from more of a public go-to-market point of view. Hopefully this has been insightful for you in my interview with Sean, and have a great day.